If you were born before the 6th of April 1960, a specific and significant set of changes is arriving in 2027 that will directly affect your state pension income, your pension pot, and the amount of money your family inherits when you die. Some of these changes are good news. Some of them are complicated, and one of them is the most significant shift in the taxation of British pension wealth in a generation. This video is specifically for people who were born before 1960 or who have parents, partners, or family members in that age group. Because the decisions you make or fail to make before the 6th of April 2027 could cost your family tens of thousands of pounds, and the window to act is closing faster than most people realize. Let's go through every change that matters, what it means in real money terms, and what you need to do before the deadline arrives. Let's start with the good news, because there is genuine good news in this package of changes, and you deserve to hear it clearly before we get to the more complicated parts. Change number 1 is the state pension increase that took effect in April 2026. Under the triple lock guarantee, the full new state pension rose by 4.8% from the 6th of April 2026. That means those who qualify for the full new state pension now receive £241.30 a week, which amounts to £12,548 a year, up from £11,973. For someone on the full new state pension, that is an extra £575 per year in their pocket, or roughly £47 extra per month, doing nothing other than continuing to receive the pension they had already earned. Those who are on the basic state pension, which applies to men born before the 6th of April 1951 and women born before the 6th of April 1953, now receive £184.90 a week, which amounts to £9,615 a year. Now here is something important that many people born before 1953 do not realize. If you are on the basic state pension rather than the new flat rate state pension, the system that applies to you is different from the system that applies to people who reach state pension age after April 2016. Your entitlement is calculated under the old rules, which means it depends on your national insurance record and whether you were ever contracted out of the additional state second pension. Some people on the basic state pension are receiving significantly less than the headline rate of £184.90 because of gaps in their record or periods of contracting out. If you have never had your state pension properly reviewed or checked against your national insurance record, this is the first action item in this video. Log into your government gateway account or contact the pension service to understand exactly what you are receiving and whether there are any gaps in your record that can still be addressed. Now let's talk about the triple lock and what it means for 2027. The triple lock guarantees that the state pension rises each April by whichever of three measures is highest: average earnings growth, CPI inflation measured in September of the previous year, or 2.5% regardless of the other two. In 2026, the winning measure was average earnings growth at 4.8%, which is why the increase was the highest it has been in several years. For 2027, the increase has not yet been confirmed at the time of making this video. But based on current economic forecasts, the full new state pension is projected to be in the region of £247 to £252 per week by April 2027. For a full year pensioner, that represents a meaningful income increase. The triple lock remains in place for 2027, and the government has given no indication of removing it before the next election. But here is the warning that almost nobody is communicating clearly. The rising state pension and the frozen personal allowance are on a collision course that has direct tax consequences for people on the full new state pension. The personal allowance, which is the amount of income any individual can receive before they pay income tax, is frozen at £12,570 until at least 2027 to 2028. The full new state pension in 2026-27 is £12,548. The gap between the two is just £22 per year. If the triple lock delivers another increase of 3 to 4% in April 2027, the state pension will exceed the personal allowance for the first time in British history. For pensioners whose only income is the state pension, Merck has confirmed that the excess will typically be collected through adjustments to any other pension income via pay, or in some cases will be administratively impractical to collect on very small amounts. But for anyone who has additional income on top of the state pension, including a workplace pension, a personal pension, rental income, or savings interest, the income tax calculation becomes more important and more careful management becomes more valuable. If your total income in retirement exceeds the personal allowance, which at these state pension levels it will for almost anyone with any other income source at all, every pound above the personal allowance is taxed at 20% for basic rate taxpayers. The practical step here is to make sure you understand your total retirement income from all sources, how much of it falls within the personal allowance, and whether there is any legitimate scope to restructure income to minimize the tax payable. A good independent financial advisor can model this clearly for your specific circumstances. Now let's talk about the state pension age change, because this is the one that is catching people born around 1960 completely by surprise. From the 6th of May 2026, state pension age began increasing gradually from 66 to 67. This affects anyone born between the 6th of April 1960 and the 5th of April 1977. State pension age is 66 plus 1 month for those born between the 6th of April 1960 and the 5th of May 1960, and continues to increase by 1 month for each calendar month of birth, reaching age 67 by the 6th of March 2028 for those born between the 6th of March 1961 and the 5th of April 1977. If you were born before the 6th of April 1960, your state pension age remains 66 and this particular change does not affect you. You have already reached or passed your state pension age under the existing rules. But if you have family members, a younger spouse or partner or adult children born in the 1960s, this change affects them directly. Someone born in June 1960 has a state pension age of 66 years and 2 months, meaning they must wait 2 additional months beyond their 66th birthday to claim. Someone born in April 1961 has a state pension age of 67. The financial cost of that delay is real. The full new state pension pays approximately £1,046 per month. Every month of delay is approximately £1,046 you do not receive. For a family member who had planned financially around a 66th birthday state pension start date, this transition comes as an unwelcome and sometimes unplanned reduction in near-term retirement income. Now let's turn to the change that matters most, the one that is genuinely urgent, the one for which the clock is already running. And that is the inheritance tax treatment of pension pots from the 6th of April 2027. For over a decade, defined contribution pensions have been what estate planning professionals call the golden goose of estate planning. Since the 2015 pension freedoms, the common wisdom has been to spend liquid assets within the estate, such as ISAs and savings, leaving defined contribution pensions for as long as possible. Because most defined contribution pensions currently sit outside your estate for inheritance tax purposes, they have been a remarkably efficient way to pass wealth to the next generation. From the 6th of April 2027, this will change. Most unused pension funds and death benefits will be treated as part of the deceased's estate and potentially subject to inheritance tax at 40% above the nil rate band. Let's make absolutely clear what this means in practical terms. If you currently have a pension pot of any size, whether a SIP, a workplace-defined contribution pension, or a personal pension, and you die with money unspent inside that pension after the 6th of April, 2027, that money will be added to everything else you own when calculating whether your estate owes inheritance tax. The standard nil rate band for inheritance tax is £325,000 for an individual. There is an additional residence nil rate band of up to £175,000 if your estate includes a home passed to direct descendants. The nil rate band is frozen at £325,000 until 2030. Married couples and civil partners can combine these allowances, meaning a couple can potentially pass up to £1 million to children including their combined nil rate bands and residence nil rate bands without inheritance tax. But once your pension pot is added into the estate calculation, many families that previously sat below these thresholds will now exceed them. The government estimates that out of around 213,000 estates with inheritable pension wealth in 2027 to 2028, approximately 10,500 estates, or around 1.5% of total UK deaths, will become liable for inheritance tax where this would not previously have been the case. 10,500 families in the first year alone. And as pension wealth accumulated over decades continues to grow, and as the nil rate band remains frozen, that number will increase year on year. Here is a concrete example of how this will affect a typical family. Take a man born in 1955, now 71 years old. He owns a home worth £350,000 jointly with his wife. He has a SIP with £250,000 in it that he has been drawing from minimally, preserving it as an inheritance for his children under the existing rules. His wife has savings and an ISA totaling £80,000. Under the current rules, on his death the home passes to his wife entirely and falls outside the estate. The SIP passes outside the estate because it is a pension. His wife is the sole inheritor and no inheritance tax is due. When his wife eventually dies, the combined estate passes to their children using the combined nil rate bands and potentially the residence nil rate band, and again, the inheritance tax position is manageable. Under the rules from April 2027, on his death, the SIP does not pass cleanly outside the estate. The pension administrator must now report the pension to Merck as part of the estate calculation. Depending on the total estate value and how the assets are structured, the picture can change materially. Planning that made complete sense under the old rules needs to be reviewed under the new ones. The practical response to this change depends entirely on your specific situation, the size of your pension pot, your other assets, your age, your health, and your family structure. But there are several broad strategies that financial advisors are currently recommending for people in the affected group. The first is to draw from your pension more deliberately than you might otherwise have planned. Under the old rules, many people with sufficient income from other sources were deliberately leaving their pension untouched to preserve it as a tax-efficient inheritance. Under the new rules, that strategy becomes less compelling. Drawing from your pension and either spending it, gifting it within the 7-year potentially exempt transfer rules, or reinvesting it in an ISA where it continues to grow tax efficiently may produce a better overall outcome than leaving it in the pension wrapper. The second strategy relates to the gifting rules. Money you give away more than 7 years before your death falls completely outside your estate for inheritance tax. If you draw money from your pension before April 2027 under the current favorable tax rules and begin a program of regular gifting to your children or grandchildren using the annual gift exemptions, the regular gifts from income exemption, or the 7-year potentially exempt transfer rules, you can systematically reduce your estate in a way that is entirely within the law and entirely legitimate. The annual gift exemption allows you to give up to £3,000 per year free of inheritance tax, with no 7-year rule attached. Gifts from surplus income, meaning income you genuinely do not need to maintain your lifestyle, can be made in unlimited amounts as long as they are regular and documented and genuinely come from income rather than capital. A financial advisor can help you structure this correctly. The third strategy is to ensure your expression of wish nominations for your pension are completely up to date. These are the nominations you make to your pension provider indicating who you want your pension to go to on your death. They are not legally binding, but pension providers almost always follow them. Under the new rules, the interaction between your nomination, the inheritance tax calculation, and your overall estate plan needs to be reviewed. Nominations made years ago under the old rules may not reflect the optimal structure under the new ones. The fourth strategy is to seek a full estate planning review from a qualified independent financial advisor or solicitor before the 6th of April 2027. The deadline is 9 months away from the time of making this video. That sounds like a long time. It is not a long time when you factor in the time it takes to arrange a professional review, receive advice, implement any changes, and ensure the paperwork is in order. The people who leave this until March 2027 will find that advisors are overwhelmed with exactly this work, and the queue will be long. Let's also talk about 2 other changes that matter specifically to people born before 1960, even if they are less dramatic than the inheritance tax change. The first is deferral. If you have reached state pension age and you have not yet claimed your state pension, you are deferring it. Every 9 weeks of deferral increases your eventual state pension by 1%. That works out to approximately 5.8% additional state pension for every year you defer. For someone in good health who expects a long retirement, deferral can make financial sense. But the break-even analysis, meaning the point at which the higher income from deferral overtakes the income you missed during the deferral period, typically sits at around 17 to 19 years from the date you start claiming the deferred amount. If you are 70 years old, the break-even on deferring your state pension is 87 to 89 years old. Whether that is a compelling case for deferral depends entirely on your health and family history. Most people at or past state pension age who have not yet claimed should claim now unless they have specific financial reasons not to. The second is the pension credit position. Reaching state pension age unlocks additional benefits, including free TV license for those over 75, the warm home discount, housing benefit top-up, and council tax reduction. If your total income in retirement is modest, pension credit may significantly supplement your income and you may not be claiming it. The government estimates that hundreds of thousands of people who are entitled to pension credit are not receiving it, often because they assume they earn too much to qualify or because they simply do not know they are eligible. The threshold for pension credit for a single person is currently £218 and 15 pence per week for a single person and £332 and 95 pence for couples. If your total income from all sources is below those levels, you may be entitled to a top-up that brings you to those amounts. This is worth checking if you have never looked into it. So let's bring all of this together into a clear action list for anyone born before 1960, or for anyone with family members in that group. The first action is to check your state pension forecast and national insurance record immediately on the government gateway. Make sure you understand exactly what you are receiving or will receive, from which system, at what rate, and whether there are any gaps in your record that can be addressed. The second action is to understand your total retirement income from all sources and how it interacts with the personal allowance and income tax. If your combined income from state pension, workplace pension, savings interest, and any other sources exceeds £12,570, you will have an income tax liability, and understanding its size helps you plan around it. The third action is to seek a pension and estate planning review from a qualified independent financial advisor or solicitor before the 6th of April 2027. Bring to that review your current pension values, your property value, your ESA and savings balances, your existing will, and any existing pension nominations. Ask specifically about the impact of the April 2027 inheritance tax change on your specific estate. The fourth action is to review all your pension nominations and expressions of wish with your pension providers and update them to reflect your current wishes and your current understanding of the new rules. And the fifth action is to check your pension credit entitlement if you are near the income thresholds and have never applied. The changes arriving in 2027 are significant for anyone born before 1960. Some of them are straightforward to manage with a small amount of planning. The inheritance tax change is the one that requires the most urgent attention. Because it is irreversible from the 6th of April 2027, because the window to take action under the current rules is closing, and because the financial consequences of doing nothing can be very substantial for families who have preserved significant pension wealth under the assumption that it sat outside their estate. The people who will be best positioned when April 2027 arrives are the ones who understood what was coming, sought proper advice, and made the relevant decisions while the window was still open. If this video helped you understand what is changing and what you need to do, please hit the like button and subscribe to UK Finance with Peter for more honest, practical content on pensions and money for people living and working in the UK. Thanks for watching, and I will see you in the next one.